Hi, good afternoon. I'm Dwayne Dipner. I'm a portfolio manager on the Nedgroup SA Equity Fund. Hello to everyone on the webinar. Today, the title of our presentation is SA, the Beloved Country, and I'll explain how SA has been extremely strong year to date and why that is the case. So if we just step back and look at what's happened in Q1 22, there's a theme that's come through from last year, and that theme is really strength in the SA markets. One big change from last year is we saw the S&P 500 up almost 40% in Rand, so a very strong run, and that's reversed. So you can see the S&P down about 12%, and that's really driven by two things. One, a strong Rand, so the Rand really strengthened into 2022, and of course worries around inflation and interest rate in the US. If we then look at the MSCI World down 13% and Eurostoxx down 19%, I mean, the extra pressure there was really down to the Russian invasion of Ukraine and worry around geopolitics and obviously the effect on Europe. On the flip side, you can see domestic SA equities up 16%, so very strong this year. And one of the big drivers of that was SA banks up 25%. So the banks been very strong. We've seen good earnings momentum out of the banks this year. That drove the Cap Swix up 7% for the first quarter, so a strong showing from the Cap Swix. And the Nedgroup SA Equity Fund was up 6%, slightly behind the Cap Swix. On the downside, we saw JSE listed global consumer stocks down 22%. That was really led by Naspers, which was down quite strongly on the back of a weak Chinese market, with the MSCI China down 21%. The market really getting worried around Chinese support for Russia, and could there be sanctions against China? This slide just demonstrates the fund's long-term track record, and you can see over time the fund's managed to outperform both the index and its peers since inception. If we just dive into the fund's performance in a little more detail, we can see over the last quarter, the 3 months, the fund returned 6%. So a decent quarter from the fund, slightly behind the Cap Swix, but still ahead of peers. Over 1 year, the fund's had a tougher time. Even though it's up 16%, it has been behind peers and the Cap Swix. But if we look at a longer term period, so annualized on a 5-year basis or since inception, you can see the fund is still handsomely ahead of peers and the Cap Swix. What I find more interesting is if we look at a rolling 3-year performance period for the fund, we can see 72% of the time the fund has outperformed the Cap Swix, and 60% of the time the fund has outperformed the general equity peers. So really good performance and consistent performance from the fund over time. If we just dissect what the key drivers of the fund were in the first quarter, we can see we did very nicely out of banks. We had a large position in banks, so Standard Bank, FirstRand and Absa coming through nicely for us. We also increased our position in Sasol in the beginning of the year, and obviously with the strong oil prices on the back of the Russian invasion of Ukraine, Sasol's done very nicely. And then diversified commodities also doing very nicely for us with Anglo American and BHP. On the downside, Naspers Process has been under a lot of pressure, as I mentioned earlier. We had a large position in Naspers Process. We used the weakness in the share price to increase our position there, and we're still very comfortable with our exposure there and think it's a great opportunity to get a good amount of exposure to a high quality set of emerging market internet assets. If we just quickly step back, and for the first time in a long time, we heard people refer to South Africa as a safe haven, which really surprised us. And if we step back and say, why is that, and why are people suddenly seeing South Africa as a safe haven in a time of very volatile markets? First and foremost, Russia, with regards to the invasion of Ukraine, is an immaterial trading partner to South Africa. So it only accounts for 0.3% of our exports and 0.6% of our imports. And secondly, and more importantly, 60% of South Africa's exports are commodities led. So that's made up of 15% platinum group metals, 15% in iron ore, and 4% in thermal coal. Of course, this is offset by our import of crude oil, which makes up about 15% of our imports, and we have seen very strong oil prices in the quarter that offsets it a bit. But generally, from a terms of trade perspective, we've really benefited from the high commodity prices in the quarter. And if we look at what's driving some of these commodity prices, we can see in the chart below that between Russia and South Africa, 60% of the global export market in PGMs is controlled by these two countries. So when it comes to worries around sanctions against commodity exports from Russia, that's really put an underpin in PGMs, and we can see that obviously benefits South Africa a lot. It's a very similar story in the coal space, where Russia accounts for 15% of the global export market of coal and South Africa 4%. And the other thing is South Africa's got the right quality of coal to export into Europe, where they are shunning a lot of the Russian coal. So that's really benefited the coal market in general and South African coal. On the downside, we can see that 11% of the global export market share of oil comes from Russia, and that's obviously put a lot of pressure on oil and energy prices, and we've seen that play through into the market for crude oil. Over here, we've got a chart of various global markets and the forward PE of those markets. We can see traditionally South Africa, the green line, traded in quite a tight PE range with many other global markets and well above the emerging market PE. You can see since 2018, we've seen a derating of the South African PE all the way to well below emerging markets forward PE. And recently, we've seen a re-rating of that market. We were saying that we thought there were great opportunities in the South African market because it had derated so much. And even after this re-rating of the South African market, we can still see it's cheaper than other emerging markets and much cheaper than other global markets, even after they've derated. So we're still finding very interesting opportunities within the South African market at the moment. If we really dissect where that re-rating came from, this is a proprietary index we put together of companies that are really exposed to the underlying South African economy. And we can see they've traded cheap for a while, and we had large positions and exposure to SA Inc. over this period. And recently we have seen quite a big re-rating in these companies. While they are less than one standard deviation away from their average, and we are selectively still finding great opportunities over there, we do think certain sectors have re-rated quite a lot and are trading closer to their fair value. If we then look at global consumer companies that are listed on the JSE, we can see traditionally they've traded at quite a rich PE, but they've derated quite a lot. And this is a space that we are now finding very interesting opportunities. So you can expect the portfolio to rotate from some domestic companies into sort of more global consumer companies in the coming sort of over the medium term. If we quickly just examine the portfolio's positioning at the moment, we've still got decent exposure to the global consumer. That's through British American Tobacco, that's trading on a, let's call it 9 forward PE and 8% sterling yield. They've just they've just started share buybacks, which we really think supports the share price. And we think the regulatory issues are overblown within the stock, so we've still got a decent exposure to that. Naspers Process, we've increased our position there, and we think buying Naspers at over a 65% discount with Tencent as cheap as we've seen it in a decade is really a great opportunity to get exposure to that complex. In the South African financial space, we had large exposure to banks. We have started to sell down our banks as they trade closer to intrinsic value, and we've increased our exposure to insurance sector, where we've got a great feeling for the back book. And we think the balance sheets are well provided when it comes to any future COVID waves and the floods we've seen in KZN, so decent exposure there. We've continued to have a decent slug of our portfolio in healthcare stocks, the key stock there being Mediclinic. We think as elective surgeries come back, this will really drive operating leverage and earnings growth in these stocks going forward. And Mediclinic trading on a sort of a 9 EV EBITDA, looks cheap compared to its peers and history. It's nicely diversified between Switzerland, the Middle East, and South Africa, so less exposure to regulatory risk in South Africa, and we still have a decent position there. And then selective resource exposure. Over here, we still prefer platinum group metals. We think the stocks are looking attractive, trading at double-digit free cash flow yields, and we think PGMs are supported in the short term through the possible sanctions on commodity exports from Russia. In the longer term, the production of OEM cars from OEMs really returning, and the world sort of refleeting and that car inventory sort of building up again, which should be very positive for PGM prices. What I always find interesting is when examining a SA equity focused fund is just to notice that only 37% of the underlying fund is actually exposed to South Africa. 42% is exposed to developed markets, and you could see this increase over time as we sell down some of our South African exposure when it gets closer to our intrinsic value. And then 15% of the portfolio is exposed to emerging markets, and that's really China through our Naspers process positions. If we look at our sector exposure, 16% to the global consumer, that would be Naspers process and British American tobacco. Still decent exposure to the banks, but this has come down over time. And then good exposure to a lot of resources, but diversified. The new position there would be in non-mining resources, where we've bought a position in Mondi. We decided on the back of the Russian invasion of Ukraine, when the Mondi stock price really got hit, that the share price is more than priced in a write-off of their Russian operations. And for a company that's very well run, a good business, we thought the valuation was looking very attractive and built a position there. In conclusion, this is the top 10 stocks in the portfolio. Currently, we think the portfolio is very nicely positioned and well diversified to generate very decent returns for our clients going forward over the medium term. Thank you very much for joining this presentation. I hope you found it very interesting, and we look forward to engaging with you at the next quarterly update.